Welcome to our investing podcast. This week we are talking about checklists as we carry on from our conversation from last week. And last week we talked about looking at moats and looking at the meaning of a company and going through various items there. And this week we are talking about management.
Mm-hmm. And to reiterate, we're going to try and build a checklist off of these kind of take-home points. And so whenever you're doing a complex task, a checklist helps so that you don't miss anything important.
Exactly.
So today we're going to talk about management. What do we look for in management? And what are some of the things that should make it on our checklist when we're discussing management? Because, well, why is management important?
Right. Well, the management, one thing that's interesting about this, just before we get into it, is that a lot of super investors that we listen to, Manesh Pabrai, Peter Lynch, Lee Lu, Warren Buffett, Charlie Munger, they are constantly talking about making sure the management has integrity. And I have said before that it's very difficult for a small investor to do that because we don't have the same opportunity to just pick up the phone, call, in the company and talk to the CEO.
Now, granted, I did that today.
You did do that today.
I actually
you didn't talk to the CEO.
I didn't talk to the CEO, but I talked to someone from Investors Relations from a company I'm looking at, and they're very pleasant. So as a small investor, you can access investor relations.
That's
now,
true.
This is a smaller real estate investment trust that I contacted. I got a hold of someone, and they answered a lot of my questions, and they answered them wisely.
Right, and you probably feel a lot better now about your decision as to whether or not to invest in the company.
I haven't made a decision yet, but I'm coming to the decision,
Okay,
so we'll
got
see.
it. So because management is probably one of the most important M's of the 4 M's that we spoke of last week, meaning management, moat, and margin of safety, because it's the most important. It's also one of the most difficult. How do we go about it?
To ascertain. Well, let me backtrack and say that there's 2 kind of frames and schools of thought about management. So if you're kind of a Ben Graham disciple, apparently, according to Warren Buffett, he didn't really believe in talking to management.
And why would you? Because it's a different type of investing, that cigar butt investing.
Right, the value investing and whatnot. And so he actually thought that potentially, and this is second information, but he actually thought his opinion could be tainted by management because managers are often salespeople and they do a good job maybe of getting you to invest in a company you shouldn't invest in, is kind of was his thinking. Yeah. Now, the other frame of thought, as you alluded to before, is Warren Buffett and Lee Lu believe deeply that management's extremely important, especially when you're going to be holding a company for a longer term investment.
And the long term, I think, is why there's the difference, because Ben Graham was just trying to get, unlock the value that was there in a company that was probably on its last legs.
Yeah, I mean, as Warren Buffett would say, it's a cigar butt.
Yes.
Had a puff or two left, and then it was kind of done and finished. So the management really wasn't important.
But it's the time frame that makes the management so important. Like if you have bad management at the helm for 10 years.
Yeah. A lot of damage can be done to a company.
A lot of damage can be done.
Whereas if you have a good company, or a good CEO at the helm of a company for 10 years, there's a lot can be accomplished in that amount of time.
Exactly.
So I think each of you as viewers and us as investors have to decide whether or not management is important. So it really depends on what kind of style of investing
like
that you're
a swing
looking
investor and a day trader, they're not going to care.
They're not going to care. If you're more of a technical investor, you're investing based on charts, it probably doesn't matter too much what management does. But if you're going to buy and hold a company, as you mentioned, for 5 years, 10 years or longer, then you're going to want to see someone at the helm that you can trust and someone at the helm who is skilled.
Yeah, and someone who is shareholder oriented.
So really, I mean, I guess our approach would be, if we truly view our investing as being when we take an investment, that we are partial owners in a business, why would we look at it any differently as to owning the whole? Now, if we owned a business, we'd want a manager who is trustworthy. We'd want someone who is honest. We'd want someone who told us when they made mistakes. So we'd want to check off a number of boxes. And so I think that's kind of where this stems from.
Right, exactly. So let's get into it. Are we going to start with numbers, or are we going to start with the quality, the quantity, the quantitative aspect, or the qualitative aspect?
They're joined at the hip. So we've developed 4 points under management, and there's going to be sub-points under there that I think are important to look at. So the first point is, are they honest and are they transparent?
Right.
So you can kind of tell that just by following the business, just either through reading annual reports or watching interviews with the CEO,
listening to conference calls.
And there's really no qualitative measure I really
Yeah.
There's no quantitative measure for honesty. Like, there's no number that you can really rank somebody. Are they honest? Are they transparent? Do they tell you when things went wrong? And when things went wrong, do they take the blame?
Do they pass the buck?
Do they pass the buck? Are they constantly ascribing maybe problems in the business to factors beyond their control?
The amount of CEOs and CFOs on a conference call who say, "Oh, it's because of this," or "Oh, it's because of that," is actually astounding. They'll shuffle the blame around to everything except for what they did in the quarters before we got here.
Yeah. So I think in developing a checklist, that just should be one of your little bullet points. Are they honest? Have I read through, maybe 5 or 10 annual reports? And have things evolved as they've said? And if they haven't, do they have an explanation as to why? Or does it just suddenly get dropped?
That's a big one for me. If you actually go back, and you don't even really need to read the entire annual report for this part of it. If you read a shareholder's letter and you read a decade's worth, you can see what their big projects were. And there are some instances where they had these projects and they failed, and they just never got brought up again.
Yeah.
In later shareholders' letters. Yeah. And a good CEO would bring it back up again. A good CEO would say, you know what, we had this and this is why it didn't work.
Now here's a thought, actually just occurred to me as you said that. Now, a shareholder's letter is not required.
No, it's not.
So one of your scoring systems could be, does the CEO have a shareholder's letter?
That's one of the things that drives me crazy about Meta, is that they don't have
There's no shareholder's letter.
Yeah.
So from that standpoint, you're absolutely correct. And that might be one of the criteria. That might score a point or 2 points, however you want to weight it. Is there something like that that's given to investors? Does the CEO care enough to do a shareholder's letter?
That's the thing, and that's what bothers me about Meta. When I look at Meta, and I just think, wow, like Zuckerberg can't even write one letter to shareholders.
Right.
And shareholders' letters are like maybe 2 pages long.
Sure.
And so it's interesting to me.
So going along with that thought, does that mean that Mark Zuckerberg's not honest?
Right.
Well, who knows? But does that mean he's not honest just because he doesn't write a shareholder letter? Not necessarily, but it might make you look into things a little harder.
It makes me think about it.
It makes you work a little harder to actually see whether things have panned out as planned.
And it does mean, to me, it shows. It doesn't mean that a CEO is not honest, but it does mean that they do not value their shareholder.
Maybe not as much as someone,
the guy who would write it, right? And the other thing about a shareholder's letter is you can kind of tell when it's a form letter.
Oh, absolutely.
Because you start reading, maybe you start reading 2010, and then you read 2011, and then you read 2013, and they just all sound the same.
Right.
That doesn't mean much either.
No, if it's just copy-paste, that's...
Copy-paste, right? And there's always some copy-paste because if they're talking about certain things within the business that haven't changed, but you can tell when the CEO has taken the time to actually write to the shareholders.
Yeah. Well, it's the CEO's chance to inform the shareholders about the business.
Yes.
And it's taking the time to update you as a shareholder, a part owner, as to what has gone on. How has management effectively managed the business of which you are a part owner?
Yeah.
Along that same vein, if a CEO is going to write a shareholder letter, it usually goes along with the annual report. And Jeff Bezos' letters are fantastic. So read Amazon's shareholders letters from 1997 to 2021. In addition, I found another company that had a monthly shareholder letter, which I thought was just absolutely unheard of.
That CEO was one of the...
He was one of my favorites.
Yeah, he was so shareholder oriented, it was crazy.
Oh, it's amazing. And I learned a lot about the oil and gas industry by reading his shareholder letters.
And he's retiring.
Unfortunately.
Yeah.
So,
what's the company, so if someone wants to go and read these?
Peyto Exploration and Development. Okay. It's a Canadian oil and gas company.
Yeah. And it's good to read.
Or natural gas company, sorry.
I haven't read the letters, but you have, and you said even if you're not interested in that company, if you're interested in oil and gas, you should read his shareholder letters.
They're just excellent.
Yeah.
Yeah. So, do they have a shareholder's letter? Yes or no? Could be one of the criteria. Are they honest? Are they transparent? Etc. The other thing that you might want to look at is, do they have a proven track record in that business or in another business?
Oh, yes.
So let's say you have a CEO that is hired on from somewhere else. Well, have they managed another business before? And how did that business do? Yes. Did it kind of flounder or did it thrive? So if a CEO is hired, how did the CEO manage the prior businesses or businesses they've been involved in? And
as Li Lu has said, a lot of these CEOs, not all of them, but many of them have larger than life personalities.
Yes.
So doing a Google search is sometimes pretty... telling because they'll come up, they are known, they have a history, and you can usually find something. So those are just some ways the small investor can do a fairly deep dive into a current CEO of a company.
Yeah. So that's point one. Are they honest and are they trustworthy? So second point to look at would be efficacy. How effective is the CEO at running the business?
Right.
So here I think you can attach some numbers to this. So really what you're looking for is how effective is the CEO and management at running the business and generating shareholder return. So what is the number we would look for there?
Well, I would look for return on invested capital.
Right, and return on equity.
Yeah.
So basically return on invested capital is a measure of how much return the management and the company is returning on money that's invested. So the whole point of running a business is to generate more money. If it's
I hope so.
right. The second measure we would look at is how is the CEO and the management team, how effective are they as capital allocators?
Yes.
Because that is the number one job
Yes.
of the CEO and management team. And so maybe that should be flipped around on its head. The first point and the second point, I'm not sure.
They're
But-
equal.
but
I
they're
think
equal.
They're equal. I mean, you can have the nicest, kindest, most honest man or woman running the company, but if they cannot allocate capital, they're in the wrong job.
Right. They shouldn't
Right?
be there.
You
Right.
shouldn't. And then you can have the most horrible person, dishonest, and if they can allocate capital, well, it doesn't matter because they might be stealing from the shareholders.
Exactly. So you're right. They're both important.
Yeah.
So that is the number one job of the CEO. So they have to be able to take that money that they've kept from shareholders, and they have to be able to generate at least $1 of return on each dollar they invest. At least. And then, on top of that, you want to make a return that's probably going to be better than what you could find investing in some sort of a risk-free investment. So like a treasury bill or a GIC or something like that. So
And it's getting harder.
it's getting harder. So as the interest rates and the rates go up, that's going to be a more difficult job for CEOs and management teams, is to find projects that generate a return that's better than what they could obtain just by investing in some risk-free assets.
Yeah, exactly.
And if they can't be doing that, then they should be giving the shareholders their money back.
Yeah. They shouldn't be using it to just fund their pet projects.
Yeah.
Or another thing that some CEOs are really bad at is acquisitions.
Right. And they pursue growth for the sake of growth's sake.
Right.
And that's really tied oftentimes to compensation formulations and whatnot.
Which is unfortunate.
Which is
That's
unfortunate.
gone
So
like
they're
that.
incentivized to grow a business, but that business doesn't necessarily have to be more profitable.
Right. And that's when you start seeing things where companies will overpay for other companies. And that just burns cash, shareholder cash. And you'll also see companies buying businesses that they have no business buying because it doesn't make any sense within the core business.
Right.
And it's very hard to actually bring two businesses together and make them work.
Right.
It takes a certain type of management to be able to do that. So when you have a CEO who's just out there buying companies for growth's sake, it can really harm shareholder return.
Right. And along that vein, if they are doing an acquisition that really doesn't seem to make much sense, they better have a pretty darn good reason why they're doing it.
They should be talking about it in those conference calls and explaining to shareholders for sure.
Or in the shareholder letter.
Yeah.
And so I think we can attach a number to this.
Yes.
Well, I know we can. The number we attach to this is
ROIC.
which is return on invested capital.
Yeah.
Which is basically where you take the net operating profit after taxes and divide it by invested capital.
Yeah.
And that gives you a percentage. So
Yeah.
we like to look for between 12 and 15%.
Consistently.
And that's the thing. It can't be a one-off. And if you have a one-off in a good way, that's something to watch out for. Don't be duped. If it's a one-off in a bad way, so meaning that it's dropped below that, maybe there's a reason.
Yeah.
So maybe you can cut the management some slack.
If I'm looking at a company and I'm doing 10 to 15 years back, and it's pretty consistent, greater than 12, 12 or greater ROIC, it won't bother me if there's a year or two where all of a sudden it went to 5, right? Or 2. Usually I can look through that year and be like, oh, that's why.
For sure. And if you
Right?
can explain why, and you can
Yeah.
expect that it's going to go up again to over your 12 to 15% kind of a hurdle rate there, then at that point you might feel it's a safe investment.
Exactly.
So again, this is just part of a checklist. So
Yeah.
Our checklist would be 12 to 15% minimum return on invested capital
Over the last 10 years.
over the last 10 years. And it has to be consistent.
Yeah. So another number that we like to look at, and numbers are fun because it is a little easier, let's be honest. It's easier to look at what ROIC is and to figure out if your CEO is honest. But another number we like to look at is ROE.
Right, return on equity.
Return on equity. So what is the difference between return on equity and return on invested capital?
So return on invested capital is just the return the business is generating on the invested capital that's there. Return on equity is how well the business is returning money to shareholders on their equity that they've invested.
On the equity within the business.
Correct.
Yeah. And we like
two different numbers,
and they're very similar.
Often very similar, but
yeah, but they do tell the story of the capability of the management to grow the company.
Right. And so there's really a couple things you might want to watch there too, just kind of off the top of my head. So one is watch for consistency. But secondly, one of the ways to gauge a good management is, have they managed to take a business that had kind of mediocre return on equity, and they managed to improve that.
That's actually true. Yeah.
So you may find you have a very good manager if you can correlate an increase of return on invested capital and a return on equity when the new management is taken over.
And of course that can work in reverse.
Correct. So it cuts both ways.
Yeah. So I like to have ROE at about 15 or higher. That's
fair.
Kind of my number.
Yeah.
I've actually read some people, and I can't remember who, it's a Canadian investor, and he likes it over 20 consistently.
Oh, wow.
He's very particular about ROE. That's like his metric.
Okay.
And he's very, very sticky that the company must have consistent ROE of over 20%.
Makes sense to me.
Yeah.
So third point is financial stewardship. So not only do they have to be trustworthy and honest, and not only do they have to run the business effectively, they should also have good financial stewardship. So what do we mean by financial stewardship? Well, by that I mean mostly debt. Have they decided to take out a lot of debt in order to try and squeeze every little bit of profitability out of the business, or kind of juice the returns, so to speak? Because taking out debt can actually make a business look a whole lot better in a lot of ways when you take out a fair amount of debt.
Yeah, you can really juice those numbers up, and you make the management look like they are really allocating capital well.
Right, and there might be reasons and times to take out debt, and if they
might be allocating capital well, but you have to be a little more. You have to do a lot more diligence for those managers, for those companies.
So just like debt for people, debt for businesses can be problematic. So if a business has a fair amount of debt, then there potentially might be some increased risk to that. Whereas if they have a small amount of debt and it's manageable, then the risk is less.
Exactly.
Peter Lynch has once said, a company that has no debt can never go bankrupt. And he's right. So, ideally, we like to see no debt, but oftentimes that's not necessarily something that you can find. And it really depends in part on the nature of the business as well. There's going to be, some companies that have, a lot of debt, and there's some companies that make all their money off of debt.
Yeah.
So from that standpoint, you're going to find businesses that do have some debt.
Yeah. I would say too, like when you're looking at certain metrics, banks don't fall into what we're talking about.
No, banks don't.
Have to be looked at very differently because of how they operate and what type of business they are.
Absolutely.
So that's kind of just a side note.
Yeah. Real estate companies and real estate investment trusts, likewise, are probably going to have mortgages and things like that. So, debt levels there are going to be a little different from your average business.
Yeah. The other thing about debt levels to look at is to make sure you're comparing within the sector. That actually really helps.
Yes.
So if you're looking at a restaurant compared to other restaurants, is their debt astronomical? Does it fall in line with the business average, or is it like really low compared? They're just a really well-managed company in that sense. To look at the businesses within the sectors helps give you as an investor an idea of what is an appropriate debt level for this type of business.
Yeah. But generally, we like to see, again, companies that have no debt, but again, oftentimes that's not realistic.
I'm more lenient with debt than you are.
For sure. And I mean, that's not an absolute number, but it's one of the things I look at. How much debt do they have?
Yeah, I like a 0.5 debt to equity or less. Yeah.
So we like to see kind of low debt to equity, meaning that they at least have assets to cover the amount of debt they have.
Exactly.
Some businesses actually have more debt than the assets that they have, and that could prove problematic if they start running into financial difficulties. Yeah. You might not see much of your money back in the event of insolvency.
Yeah. Now, one interesting thing to say about debt is that when interest rates were really low, to the point of like 1 or 0, it actually didn't make sense for companies not to use debt, and that's where it started really changing.
Yeah.
And now I think is when we're going to see. I think for a long time we didn't actually see the problem that debt was for a company, but I think now as interest rates are going up, and if they continue, we might start seeing why debt is a bigger problem than what has been shown as of late.
Yeah. And along that same vein, if they do have debt, is that debt serviceable, right? Because the last thing you want to have happen is a company have to sell assets to cover their debt. Right? So that can happen. So let's say business starts to slow down. There's vicissitudes in business, period. And so if they start to go through a bad spell, are they going to have to sell assets in order to make payments to their debt holders.
Yeah.
And that's the last thing you want to see as a shareholder.
The other thing you don't want to see is if they have a lot of debt and interest rates go up, all of a sudden their interest expense
starts to creep up.
Starts to really creep up, and that comes out of their revenues.
Right.
And all of a sudden they're making a lot less. Their bottom line's getting a lot smaller because their interest expense now is so expensive because those rates went up.
Yeah. So one of the things I like to look at is the cash flow to debt ratio. Mm-hmm. And so that kind of just gives you an idea as to how long it would take the business to pay off the debt if they needed to.
Yes.
And again, I don't think you need to have an absolute number here, but if you were to look at, say, wanting to pay it off in 5 years with their cash flow, you'd be looking at a cash flow to debt ratio of 0.2. If you wanted less, then obviously it'd have to be higher than that. So maybe somewhere around 0.2 to 0.33 would be reasonable or something like that. So I'm just pulling numbers out there. Again, it would really have to depend on the nature of the business and the industry you're looking at. It wouldn't be a hard pass for me if those numbers didn't line up.
Right. But debt is one of those things that you have to be very cautious of because it can be great until it's not. And
Correct.
Then it can be very, very bad.
Yeah.
And I think it's Warren Buffett who says you don't know who's swimming naked until the tide goes out.
Yeah. Well, and it's at that point when there's businesses that have more debt and they've gotten themselves into more trouble when they start having to sell off good assets to businesses that have been more fiscally responsible and who can then capitalize on that in opportune time for these businesses.
It's really great to think of a company like a person. Mm-hmm. I've said that before. I look at companies like living organisms. You always talk about how corporations are like a person. You have to treat them like a person. And it's the same thing. If a person is way over indebted and all of a sudden they can't service it, the banks are not kind.
No, they're not kind. They won't be kind with the ratings.
Yeah, exactly. Yeah. So and then it works as this negative flywheel.
Yeah.
And, even if the company ends up being okay in the end, the share price is probably going to show that this company is really struggling.
Yeah, it's going to suffer.
So you don't want to get caught up in that.
Yeah. So for us, I mean, from a checklist perspective, we look at debt. That's one of the things on our checklist. Does the company have debt? Yes or no? And how much debt do they have? Is it serviceable, basically? Yeah. And again, that's going to depend a lot on the industry. So the fourth point on our checklist is, does management eat with us? Mm-hmm. So what do we mean by that? Do they own shares?
Yeah, exactly.
Do they own shares in the company?
Yep.
And if they do, how much of their net worth is tied up in that? And you're never going to have a hard and fast knowledge of exactly that, but you can get a general sense as to how much of their net worth might be tied up in the business with you.
The other thing, too, is not only do they own shares, are they buying them on the open market with their own money? Not just like a lot of these guys own shares, but they've been given them.
Right.
So how much of these shares have they bought with their own money? That's a little more difficult to find. Yeah.
Now, that can cut both ways in a sense. So have they been buying shares on the open market? If that's a kind of a general bullish signal for us, or a kind of a green flag.
Unless the company's floundering. Because we have noticed that there have been times where a company is in the news a lot and it's not doing well. And you'll see the CEO do an open market buy. But then and it sounds like a lot, right? Because these CEOs make a lot of money. But then you kind of start looking at what they actually get paid every year and how much they bought. And you're like, oh, that's not really that much. And then you had a question like, are they kind of just doing this for publicity? Like, oh, look, I'm buying shares. My company's okay.
In a sense, are they shilling it?
Yeah.
Are they shilling their business?
Sometimes we've witnessed that. And, the media writes an article and it sounds so great.
CEO of XYZ company is buying shares.
Right. Bought $2 million worth of shares. But meanwhile, the guy's making like $30 million in compensation every year. And you're like,
So, I mean, from a sense, you could see that it would be a small price to pay for some publicity to try and get a little bit of a bump in the share price.
Like, look, my company's okay.
Right. So that cuts both ways. So if they're making consistent purchases and fairly decent sums, that's probably a decent signal. If they've made a relatively small purchase and
in comparison to what they
earn, and again, it's not an absolute. So, but we like to see CEOs and management buying shares. Yeah. And same thing with people on the board of directors. Yes. So we like to see insider buying. So is there insider buying? To summarize, do they own shares? And even better yet, are they buying shares? Yeah. Now a red flag would be, are they selling shares? Now that's not an absolute thing either. If it's a small amount of shares, here and there, then maybe they're wanting to buy a new house, or maybe they're
going through divorce.
Who knows why, right? But if there's large blocks of selling, then oftentimes that's a pretty big red flag.
Yeah. And we were told for a long time by many people that we listen to, like, you know, selling doesn't bother us. We love buying because buying means one thing.
Yeah.
Right? And we kind of learned recently, like I said, that sometimes it is a publicity stunt. So most of the time it can mean something, but you know, you got to watch.
Yeah.
And then you would hear them say selling doesn't really matter because people sell for all sorts of reasons.
Right.
But we really learned a lot in the past year, so you can extrapolate on that.
Well, I mean, I can think of 3 examples of where CEOs and major insiders sold, and not long after that, the share price dropped precipitously. Yeah. So one was Jeff Bezos sold a large stake in Amazon, and shortly thereafter, Amazon, you know, had a pretty big tumble in share price. Mark Zuckerberg, he was selling quite a large number of shares for a while. You know, it was in the 300s, and it quickly tumbled after that. Probably several months to a year after, it tumbled
a lot,
quite significantly. And of course, Elon Musk.
Yeah.
So Elon Musk was selling when things were quite high, and again, the share price has suffered, you know, appreciably since he's done that.
Now, it's interesting that those are all CEO founders.
Yes.
And these guys know what their company's worth. A founder, the company is their baby. They know everything.
Yeah.
They live and breathe their companies.
Yeah.
Right? And so, to me, when people say, oh, selling doesn't matter, when you have a CEO founder, and he's not just selling, but he's like offloading.
Right. So he's selling, you know, large percentages of ownership, you know.
And
I don't have a number on it, but if you can use your judgment, if they're selling, you know, 5%, 10%, 20% of their shares, that's a red flag.
Yeah, and constantly.
Yes.
Like Musk was selling like it was
day
like
after day after day. Yeah, same thing with Zuckerberg.
Yeah, it wasn't surprising to see what happened, the companies fall, because they're not going to let go of those shares if they didn't think that they were going to unlock a lot of value there.
Yeah. And these guys know their businesses inside and out. They've built them. Yeah. And so they know what it's capable of. So again, insider selling, red flag. Insider buying, probably a good thing.
Yeah, especially if they're buying day after day or week after week. We were following one company, and the CEO and the CFO, they were buying like literally every day for months. Yeah.
So under that same point, one other point is share-based compensation. You had a few things to say on that.
Well, we're talking about management and how to assess them, right? So we have, are they honest?
Yeah.
How do they allocate capital?
Yeah.
Are they buying and selling? Are they eating the cooking?
Yeah.
Right. And so if you think about compensation, are they just paying themselves just gross amounts, because that comes out of money that could go to the shareholders, or it could go back into the business to grow that business, which of course eventually would go back to the shareholders.
Right.
So the share compensation to me shows how much they actually care about the shareholder.
Yes.
Yeah.
Now, I found a company a while back where the CEO got paid something to the tune of $7 million in share-based compensation. But the market cap of the company at the time was something like $30 million. And it had suffered an appreciable drop in market capitalization from when he had gotten paid all those shares. Right. So to me, that screams a CEO who's just taking advantage of shareholders.
Yeah.
So share-based compensation, you want to reward your CEO and executives based on performance and whatnot. And, you know, they will be incentivized in a way, you know, with share-based compensation. But if it looks like it's just extraordinary, then that's a red flag as well.
Yeah, and I mean, now a lot, I don't even know what extraordinary would be anymore, because it just seems like these guys are just milking that system. But if something jumps out at you, you might want to take a deeper look.
Again, it may be something, again, on that checklist just to look into, you know, is there share-based compensation, how much, and how does it equate to peers. Yeah. So if the business is performing well, maybe you don't mind that they get, you know, a significant number of shares.
You also want
as
to make
part of
sure,
a share-based compensation package.
Yeah, and you also want to make sure what their compensation is based to, because sometimes they link the compensation to metrics that can be fudged or metrics that can be exploited.
Yes.
And CEOs have been known to exploit these metrics just so that they get their bonuses. So you really got to be careful with that, because I think that does speak volumes when the compensation just doesn't align, when something's fishy. So I know that you said that you read an article about share buybacks where they buy back these shares, so it looks like they're buying back shares, but then they're actually using it for compensation.
Google and Meta were notorious for that.
Yes.
So what they were doing is doing heavy share buybacks.
So
with corporate dollars, with money that was, you know, retained earnings and whatnot. They were buying back significant amount of shares, but all the while they were releasing shares in the form of executive-based compensation
Exactly.
to their executives and managers and whatnot.
Which is not
to
a
the
true
tune
share
where,
buyback.
which is not a true share buyback because the actual share count never really went down.
Exactly.
And so Google and Meta were cited as examples of where that was happening just en masse.
Yeah.
To the tune of hundreds of billions of dollars between those two
So
companies.
that's one of those financial shenanigans that you got to look in. Like,
Yeah.
they're buying back shares.
Yes.
But this is not bringing any value to the shareholder.
But it's actually an expense to you as a shareholder.
Yeah.
That's money that was yours and should have gone to you, but
Yeah.
instead has gone to the executives.
Yeah.
So I mean,
shiesty.
it's shiesty. Whereas Apple was actually cited as a company that did it well. They actually decreased their share count significantly, and they did a lot of
truly decreased.
They
did
did true
buybacks.
share buybacks.
They
Yeah.
did true share
I mean, they
buybacks.
did some executive-based compensation, but it was far outweighed by the decreased number of shares.
Right. Yeah. So that's something to look at.
It's something to look at. So in summary, we look for honest and transparent management. We look to see if the management is effective. Are they able to generate at least 15% return on invested capital? We also look for whether they are conservative with our finances as shareholders. Are they taking out extraordinary amounts of debt, or are they a little bit more fiscally responsible? And then lastly, are they eating their own cooking? Are they shareholders with us? So by being shareholders with us, they have our best interests at heart because they have their own best interests at heart.
Exactly.
Because our money is also their money in that respect.
Yeah.
So those are the 4 things that we look for in developing a management checklist.
Yeah. So I guess we'll leave it there, and we'll talk about margin of safety
Yep.
next week.
Next week.
If there's anything else that you look in management, leave it in the comments. We would love to hear it.